Welcome to Fireside Chat. My name is Sai. If you're new to my channel, I talk about how you can budget, save, and invest to achieve financial independence. Check out my other videos about how to calculate your financial independence numbers, how much money you should save in your emergency fund, and what low-cost index funds to invest to achieve financial independence. In this video, let's talk about what you need to do to create generational wealth to pass down to your loved ones or your children, as well as how you should protect your assets from outsiders or a court judge from deciding how to distribute your wealth upon your death. Here's my quick disclaimer. I am not a financial advisor or a legal counselor. This channel and its videos are for pure educational and entertainment purposes only. What does it mean to build generational wealth? By definition, generational wealth means passing assets down from one generation to the next. These assets can be your business, retirement accounts, savings, CDs, vehicles, or anything that is considered valuable. Most people set up their life insurance policies so their beneficiaries can receive the proceeds tax-free. So basically, when you designate a beneficiary to your assets to your children or grandchildren, you're building and growing generational wealth in your family. Here are the 5 steps you should take to create generational wealth. Step 1. Grow and diversify your assets. So number 1, let's talk about stocks. The stock market is probably the greatest place to grow your wealth in the long term. If you're a brand new investor, start with low-cost index funds and just let the money grow itself. You can open a standard brokerage account, or also known as the taxable brokerage account, or also known as non-retirement account. You can have either an individual or joint taxable brokerage accounts. There are no limits on how much money you can contribute to this type of account. The taxable brokerage account is what I mainly use to achieve my financial independence number. Another type of account is the retirement accounts. You can also buy stocks with your retirement accounts like your IRA and your 401k accounts. They are the same as the brokerage accounts, however, there are limits to how much you can contribute, and the tax advantages are different than the taxable brokerage accounts. I'm going to make a separate video about this specific topic, otherwise this video will take too much of your time. You can also invest in the stock market using the college savings plans like the 529 or the ESAs. I personally have a Vanguard 529 college savings plan for my daughter, but if she chooses not to go to college, I can change the beneficiary to someone else in my family. You can actually name anyone as a beneficiary on the 529 account. You can actually assign yourself as the beneficiary as long as you use it for your educational expenses. Every state has different rules and laws about the 529 plan, so make sure you do your due diligence and do some research on the 529 before you open an account for your kid. The other type of brokerage account would be the custodial accounts for your kids, but it is set up for minors under the age of 18 or 21 depending on the state law. You can also choose to open UTMA or UGMA if your state allows it. They are pretty much the same thing, except UTMA allows you to buy real estate. So for the 529 account, you can change the beneficiary. However, for the UGMA or UTMA, you cannot change the beneficiary as soon as you deposit the money into that account. The great thing about this UTMA or UGMA account is that your beneficiary gets to use this for non-educational expenses. So for my daughter, she can use this money to make a deposit for an apartment, buy a vehicle, or pay her bills, food, clothes, or whatever she needs. Alright, so number 2, let's talk real estate. If you're going to live in the same house until you pass away, your beneficiary can take over your house tax-free as long as it's below $11.7 million as of 2021. If you're married, the amount doubles to $23.4 million if you both pass away in 2021. According to the IRS, anyone can give away up to $11.7 million during their lifetime without paying federal estate tax, which is at a 40% rate. If you have multiple real estate properties, then you would most likely have the series of LLCs to protect your real estate assets. You can set up a family LLC after you do your own research with the state's legal process. Basically, you and your spouse can have the total control to buy, sell, and distribute all of the assets in the family LLC. Once you add your children or grandchildren as non-managing members in the family LLC, then you can transfer any assets, including real estate properties, to them within the LLC. Again, this is not financial or legal advice, so please consult with your estate attorney for further guidance. And number 3 is to create a business to pass down if that's the path that you're on. There are many successful family businesses like Walmart, Chick-fil-A, Ford Motor Company that have grown from small mom and pop store to a gigantic corporation. If you want your children to take over your business one day, you should include them in the business from a very young age. This is probably the best way for them to learn the day-to-day operations and financial management. However, if your kids don't show any interest in taking over your business that you have built, then you should sell the business to somebody else who is more capable if you want your business to continue to grow generation after generation. And number 4 would be the life insurance policy. This is a topic that no one really likes to talk about. Personally, I want to make sure that my family is financially taken care of while they're grieving for the loss. If you're a single parent with minors, then stay tuned. I'm going to share with you what you need to do to protect your assets later on in step 4. Step 2, designate your beneficiaries. Alright, so that was a long step 1, but step 2 is going to be the most crucial step to you. Here's what I need you to do. I need you to log into every single bank account, investment account, retirement account, and assign a beneficiary to each of that account. Did you know that 60% of Americans saving for retirement forget to do this part, forget to assign a beneficiary to their accounts? Many of them were recently divorced and forgot to update their beneficiary information. So what happens is that the money ends up going to the ex instead of going to their parents or whoever. So unless you want your ex to get rich upon your death, I would recommend that you log into every single account and start updating your beneficiary. You should also have a contingency beneficiary in case something happens to both of you and the primary beneficiary. Most of the people would assign a spouse or someone that they live with as the primary beneficiary. You need to have a conversation with someone that you trust 100%, so in case something happens to both you and the primary beneficiary, and that person is going to be ready to take over your assets. What you don't want to do is for your assets to end up in probate and having your ex and your family fighting each other over your assets. If you're a single parent with the children under the age of 18, I want you to listen very carefully. Do not designate your children as the direct beneficiary. I want you to create a living trust instead. That way, if you pass away and you still have your minors, create a trust and have the life insurance policy or any other assets paid directly to the trust upon your death. You need to assign someone you trust 100% to manage the trust until the kids turn 18. Otherwise, your assets might end up in court and the court judge is going to assign a guardian to look after your kids' inheritance until they turn 18. And I'm going to talk more about the living trust in step 4. Step 3, write your last will and final testament. So first, you need to list all your assets on your will. And next, you need to assign who you want to take over those assets when you pass away. If you have kids under the age of 18, you should assign a guardian in your will. The last thing you want is for the children to end up in the foster care. You should also assign someone to execute your will. It can be an attorney, a family member, or whoever you want. You need to tell whoever is in charge of your will to how to access your will documents upon your death. In my opinion, you should review your will every year or whenever you have a significant life event, like if you got married, you got divorced, you had a kid, or one of your beneficiaries passes away. Also keep in mind that your will becomes a public record when you pass away. So if you want to keep things private, I would suggest you create a living trust. Step 4, Create a living trust. Trusts are not public record when you pass away. All the documents inside your trust don't go through probate, so they don't become a public record. I think the nice thing about having a living trust is that you have a total control of your assets and how you want it to be managed when you pass away. You can create a living trust with an estate attorney or on your own. Inside your trust, you're gonna have what's called pour over will. So when you pass away, none of your assets would fall into probate. You need to check with your state to make sure your estate allows this. The other benefit of having a living trust is if you become ill or incapacitated, the successor trustee you appointed can keep your house in order. It would make sense to assign your spouse to become the successor trustee. However, if something happens to both of you at the same time, then you need to assign someone else you trust as the alternative successor trustee. That person can also make any medical decisions on your behalf. Once you create the trust, I would redesignate the beneficiary directly to the trust. That way, the life insurance payout, bank accounts, brokerage accounts can go directly to the trust. So, should you get a will or a living trust? And this is what I would do, and this is not financial advice. If you're single and have no kids, and you have less than $100,000 in net worth, I would just write a will. But if you care about your privacy and you're married or divorced, have kids, and you have at least $100,000 in net worth, then I would go with the living trust. Step 5, teach your children about personal finances. So my personal definition of generational wealth is teaching my child about personal finances. I wouldn't want my daughter to be categorized as one of the trust fund babies who never works for a day in her life. I want my daughter to become a strong and independent woman who can create her own generational wealth to pass down. I want to teach my child how to budget, save money, invest in the stock market, invest in real estate, and build a business if that's something she chooses to do. I want her to be able to create her own budget when she goes to college or gets a job. Did you know that 1 in 4 parents never talk to their kids about personal finances? I was one of them. I mean, don't get me wrong, I am not blaming my parents for my financial mistakes, but I want to make sure that my daughter does not make the same financial mistake that I did. If I knew what I know now, I think I would have reached my FIRE number like 2 or 3 years ago. Also, look at the stats. According to CNBC, about less than 17% of students were required to take personal finance class in high school. When I was in school, no one ever taught me how to budget, invest, or buy a real estate property. We have $1.7 trillion in student loan debt. It's an epidemic. But 54% of the college students who took out debt didn't figure out their future monthly payments before taking out student loans. So how is it possible to allow 18-year-olds to take out so much money in student loan without proper financial education? Now, you don't need to tell your children about everything that is going on in your household, about your budget or anything like that. I started teaching my daughter about personal finances when she turned 7. I think that's a good age to start. So I bought her a piggy bank and taught her how to count pennies, nickels, dimes, and quarters. I've been teaching her how to save half and spend half, like my 50-50 budget strategy. So whenever she earns money from doing her chores or whenever the tooth fairy comes, she will put the money in her piggy bank right away. So once a month, she gets to take some money out of the piggy bank and we go shopping at Target, Walmart, or wherever, and she feels better about spending her own money with the money that she earned. I want her to develop good saving and spending habit, and I need to be the example of making smart financial decisions. I strongly believe that a legacy of wealth can only be carried on from one generation to another through financial education and knowledge. Thank you so much for watching my video. Let me know in the comment section down below what your thoughts are on creating generational wealth. I'm going to post a new fire video every Sunday at 9 a.m. I hope to see you in the next video. Have a good one. Thanks for watching. Don't forget to hit the like button and subscribe for more fire videos.